Good evening, friends. So, we've had today the annual budget for the next year being presented in the Lok Sabha by the Finance Minister, Mrs. Nirmala Sitharaman. And the budget, which in constitutional terms is the annual financial statement, but it attracts a lot of attention, not only of the media, but any person who is either a taxpayer, any person who's dabbling into stock market, and any person who's generally concerned with the economy of the country, and more particularly because a budget is a futuristic document. It projects and makes projections for the next year, that is starting from the 1st of April, and also kind of read with the previous economic survey, gives a bird's eye view as to how you would expect the government to handle the economy, how the government is expecting the economy to behave, and what is the intervention, if any, of the government in the handling of the economy. Now, in the context of the unfortunate incidents of Republic Day and so on, the atmosphere in which the budget was presented was far from ideal, but definitely it must be said to the credit of the members of the House of People that overall presentation of the budget was not marred by any unruly scenes. And budget, as you know, budget speech comprises two parts. And part A, which is a lengthy part, it is a part where the government really kind of highlights the schemes in which it intends to make investment, what are the thrust areas. And then, of course, part B is the more interesting one, where the taxation issues come in, and any person, whether he's a senior citizen or a student, every person is trying to, have a look at part B, which really is the interesting part of it. But unfortunately, the established procedure is that we spend almost 1 hour on part A, which is nothing but dry statistics. And thereafter, we get on to the more interesting part. So I would be speaking basically from a mix of perspectives. A budget is, of course, too voluminous a document for a single person to analyze and read. But some of the points are which capture the imagination of the media, of the people, and hopefully of the newspapers tomorrow. And it is on those that I would like to focus my attention this evening as I reconnect with my Facebook friends live after a significant time, I would say. Now, fiscal deficit. No, fiscal deficit is one parameter of the budget which every person asks. What exactly is fiscal deficit? People would give you complicated definitions, but what I would say is this, that you have all the receipts, all the income of the government on one side and all the expenditure on the other side. And there is a difference. What is the difference? Is the deficit, and government ultimately makes up for the deficit by virtue of borrowings. Now, whether that borrowing is from the open market or the RBI is a matter of detail. So fiscal deficit is always seen as a kind of borrowing deficit which the government must necessarily do. Now, fiscal deficit, if you see, is something not to be seen only in absolute terms. It is something which has to be seen in terms and in relation to the GDP. So what is the GDP of the country? And fiscal deficit, if you would like to see with reference to that. Now, the current year, which ends on 31st March, and the current budget, which is on, was presented before the onset of the COVID pandemic. And therefore, at that particular time, we had, or the government had anticipated, a very healthy fiscal deficit of 3.5%, which would be a very ideal type of a picture. But who knew that we were in for a huge pandemic globally? And the estimates now, as the year would close on 31st March, is 9.5%. So the government really is trying to tell you that it had two options. One option was to do nothing, not borrow, because government revenues were going down. There was a lockdown. So the income tax, GST, etc., no business was being done. Those income sources were drying up. And therefore, what would the government do? The deficit was increasing. The government took a conscious decision, and there has been no controversy. Every economist around the world, domestically, internationally, have said that when you hit a recession of this order, which is global in nature, what you need to do is to borrow rather than sit mutely. And of course, you cannot even tax, because that is the time when people need boost. You need to spend either in infrastructure projects or put money directly into the rural and agrarian pockets. And that is exactly what the government of India did. Huge borrowing programs. And luckily, the interest rates were benign. There was a lot of liquidity in the market. It is not as if the money was not available. To cut the long story short, huge borrowing done in the current fiscal year by the government of India, which would leave us with a fiscal deficit of 9.5% as in proportion to the GDP. And for the forthcoming year, that is year 21-22, it has been estimated that the fiscal deficit as a proportion and a percentage of the GDP would be 6.8%. So, all right, this was an extraordinary year, 9.5%. What the government would manage is 6.8%. So therefore, you have borrowings to be done. There would be boost in income also. You're not curtailing expenditure. So you are not trying to go to 3.5% fiscal deficit immediately. What you're trying to do it gradually. And for the next year, the fiscal deficit is projected to be 6.8%. And of course, a long-term roadmap has been given, and which has been said that it would be till 2025-26 back to 4.5%. So therefore, this was an extraordinary speed breaker which the economy domestically and globally bumped into, and we have been able to manage that. And by way of a caveat and by way of a footnote, I would say, this huge spike in the borrowing and fiscal deficit in the current year, and this is particularly important in the context of the farmers' agitation, is 2 lakh crore rupees which FCI had borrowed against the small savings account has been transferred now to the union budget or the consolidated fund. Now this is a matter of accounting detail, because the small saving fund it may be distinct from the consolidated fund, but ultimately all the payments of your Kisan Vikas Patars and so on, including your public provident fund, are guaranteed by the government of India. But obviously it was kept outside the books of government of India in the previous years. 2 lakh crores of accumulated loans to the FCI, which people would quote unquote say are the farm subsidy or the losses or inefficiencies, whatever, has also been taken on. And that is a part of the fiscal deficit now. So a huge surge in the borrowing, moderation in the next year, and thereafter gradually going back to 4.5%. But the government is sending a very clear message that it is not hesitating to borrow. And of course, as the GDP grows, not only does your GDP fiscal deficit in proportion come down, you're getting more taxes. So the key in case of controlling the fiscal deficit is really to grow at a reasonable rate, and you grow if you boost demand, and it is a benign cycle which the government is trying to trigger off. Of course, in this whole budget news, the 15th Finance Commission, which really tells you as to what are the state share in central taxes. So that has also been tabled, and basically it says 42% of the central divisible pool, including customs duty, central excise, XYZ, whatever, the state share is going to be 42%, which is precisely what the 14th Finance Commission did. In the intervening period, which is the current year ending on 31st March, it was 41%. This 41 to 42 is basically a marginal adjustment because Jammu Kashmir is now transferred from a state to union territory. So no big surprises on the Finance Commission side, 42% of the divisible pool going to the state government. And in terms of a particular sector, before we address other issues, the health sector in the forthcoming year has shown and has allocated 2.23 lakh crore, 2.23 lakh crore, which is 137% boost over the budget estimates. Now, when we're talking in terms of percentages, this was what was a budget estimate. That means a business as usual health budget. You have not only doubled it, which would be 100% increase, 137% increase for the health sector. A very, very welcome allocation, and no one would, of course, criticize this. This includes 35,000 crore for the COVID vaccine and more than 64,000 crore for Prime Minister's Yojana to fulfill our obligations for the primary health centers and the civil hospitals and the dispensaries, and of course the intermediate level before we go to the tertiary, because the key is that if you are able to handle your patients at the village level, at the block level, then at the civil hospital level, then the tertiary care, which is far more expensive and cannot be there all over the country. So health sector, especially in focus, 137% increase, COVID vaccine provided for 35,000 crores. So this is the macro view. Now, I would like to touch something which various people have been talking about since this budget speech mentioned this. This is about our, what I'll call as super senior citizens, that is our taxpayers and citizens who are 75 years or above. Now, it has been said that they need not file an income tax return, and some of our friends, of course, the caveat is if the only income that you have is from your pension and interest income on banks. I mean, if you have income from rentals or dividends, then of course you got to file the return. But the caveat here is that you need not file the return, fine, but no one is saying that your entire income is tax-free. No one is saying that you're sitting over an FDR of 10 crores and getting a crore plus, let us say, interest income, you're not going to pay any tax. All that it is saying is that the tax would be deducted at source and you therefore need not file a return. So what I would say is that it is fine. You are, obviated the need to actually file an income tax return. But in terms of the tax benefit, if any, that of course it is neutral. Although I would say that now, for instance, saving bank accounts, the interest portion does not have or does not attract TDS. Of course, you add it to your returned income. Now, if there is TDS taking place, your tax is deducted immediately and your cash flows are actually attenuated. But having said that, a good initiative for our super senior citizens. Another thing which really had a lot of people asking me questions, asking each other questions, was this agri-infrastructure cess, which on one side was being imposed, and then they were saying that the custom duty is being decreased. So what actually has been done is that for commodities like gold and silver, and even agriculture produce like apples, peas, cotton, they have imposed a cess after reducing the custom duty, which effectively means that you are indirectly transferring the custom receipt into an agri-cess, which would technically be earmarked for creating agriculture infrastructure, or whether that is going to be in terms of huge dams or irrigation network or village level distribution, khade pakke karani schemes, that remains to be seen. But this also sending message that where you have a competing import like apple, peas and cotton, government is imposing that cess. But it is also being said that while the custom duty is being brought down and the cess is being imposed, the overall impact to the consumer is going to be zero. So if the consumer is not paying more, obviously the government is not getting more, then what is the fundamental objective of this agri cess and reducing the custom duty and imposing the agriculture cess? So some of our friends have been saying that this is basically to focus that this is dedicated for agricultural development and agriculture infrastructure. And a view also has come that once you put it as an agriculture cess by taking it off the customs duty, then we've talked in terms of the Finance Commission, you do not really owe this money to the states as states share in central taxes. Of course, these agri cesses would eventually be spent by the state governments. Government of India does not have a machinery to create agriculture infrastructure. In that sense, of course, it can execute huge, big, mega projects. That's a different thing. Then there is a very interesting 0% coupon bonds. Now, for long-term infrastructure projects, again, it was not very clear from the budget speech. What does it mean? I mean, why would I put my money into a 0% bond? Do I get any tax deduction? And if it is 0% interest, there is no interest accruing. Why would I put my money, or any investor put his money in a zero coupon rate infrastructure bond unless you're giving me a tax relief? So what a few scholarly people have told me is that these would be seen basically as capital gains. For instance, we used to have Indira Vikas Patar in good old days, money doubling in 5 years, in 5.5 years, and no interest was paid in the intervening period. But then the income tax department, CBDT, said on 14.87% notionally you will have to pay the tax because that is the interest which is accruing irrespective of whether you're getting it or not. But this 0% infrastructure bond may give me as an investor or any institutional investor the capacity to then invest and look for capital gains, which would be A, if it is long-term, 20%. B, would also give you the benefit of indexation, so partly neutralizing the effect of inflation. In other words, you do not pay the type of tax which you did for normal securities at the interest level, and moreover, the question of the capital gains would arise only A, if you sell it on the secondary market or the bond is ultimately redeemed by the issuer. Then, of course, there is a very ambitious program for disinvestment. You can call it privatization. Public sector undertakings, listed companies would be on the block, and 1.75 lakh crore is the type of money which the government is thinking in terms of raising. And any shortfall, of course, in this particular sector would immediately increase the fiscal deficit, because this is an income that you are trying to include. 2 public sector banks and 1 general insurance company, those would be on the block. Of course, ONGC, LIC, and so many other Government of India central public sector undertakings would be candidates for disinvestment. And so the government is very clear that we have no business to be in business, and that is what they are saying, and going in for a very ambitious disinvestment program. No one is calling it privatization, but ultimately those companies are going to land up in the hands of private investors, and also maybe overseas investors, because government has raised the foreign direct investment in the insurance sector, which is bringing long-term funds to 74%. So maybe you would have international players either on standalone basis or on basis of partnership with local partners coming in and picking up Government of India's stake and then running them on the sound principles of private sector management. Of course, the stock market has been celebrating. The Nifty and the BSE Sensex has been over 5% when the markets closed. And it is said that of this century, I was certainly that this is the biggest ever percentage increase in Nifty of the century. Then suddenly I realized that this is only 20 years. But nevertheless, right now, whether after digesting the overall footnotes and finding there are no nasty surprises, this could continue. But at the moment, there has been no sign of any selling pressure emerging, and Nifty 50 closed 5% up. So that is what the stock market is saying. And then for the NRIs, I think there is a very, very significant message for the NRI friends. One-person company, NRI, who was not earlier eligible to open that. A resident Indian could. Now NRI can open up a one-person company. And another very important announcement for our NRI friends is that there will be no double taxation. Government of India and the Ministry of Finance, Department of Revenue, Central Board of Direct Taxes would be notifying rules that the income of NRI is not double taxed. Now, what does that mean? For instance, you have green card holders who are basically Indian citizens having a resident visa in USA. Similarly, PR people of Canada and elsewhere. So you could be working there, you are taxed there. You could have a rental income here in India. You could have a fixed deposit on which you are paying income tax. Now, what normally happens is that there are country to countries double taxation avoidance treaties, which essentially tell you that, okay, all the income which is on account of your efforts within the resident country, which is overseas, will be taxed there. But something which owes its origin to your immovable property or your investment in India would perhaps not be taxed. But there was a lot of litigation, a lot of non-clarity, and now it has been clearly said that rules are going to come, and essentially what is going to be said, and this would equally apply to our friends from Merchant Navy who remain outside, have non-resident status, as to what is happening to their income, which is earned abroad. Are you going to tax it in India or not? So similarly, the Indian income, how do you avoid it being taxed by an overseas jurisdiction? A good, very good message for the NRI friends. Another thing which was there and no one knew, at least I didn't know that this provision did exist. In the Employee Provident Fund, we all know in the private sector, in the corporate sector, even the public sector undertakings, it is a default. So you make your contribution and the employer makes his contribution. There is a bare minimum. And like in our provident fund or public provident fund, the interest accrued thereon, howsoever large, is not taxed. Whatever you withdraw is also not taxed. Now, what was happening was some highly paid corporate employees were depositing huge sums of money from their salary, of course, running into lakhs and crores of rupees per annum. And they were not only getting the tax benefit, the interest income was not being taxed. At the same time, more importantly, you were getting a tax-free return of approximately 8%, and when you ultimately withdrew the money, there was no tax. So now the EPF has been capped. You can deposit lakhs of rupees if you want, but the tax benefit would be restricted to 2.5 lakhs. Therefore, a normal average employee contributing about 20,000 bucks per month, he gets the full benefit. But beyond that, if you want to save, then it is like saving in a fixed deposit receipt. The accrued interest would be taxed. Now here I can kind of underline and underscore that government employees of Government of India as well as state governments who have their general provident fund. There is no contributory fund. Of course, there's a new pension scheme, that is a different matter. There is no such upper limit. For instance, there is a lower limit, you must deposit this much. But if a person is trying to make saving 80% of his salary because he finds this is the best investment, then he's still getting the benefit of tax-free income on his general provident fund. But now that question would or could perhaps come in the subsequent years, that why should the government employees have this facility which you have drawn from the private sector employees? So that would be something which we have to wait and see. Another important announcement from the income tax procedure has been the IT-80 faceless system. Now, if you know, the bulk of the income tax assessment previously has already been declared, is going to be faceless system. You file your returns, some officer sitting somewhere you don't know is going to be assessing, putting queries, you're answering. There is no face-to-face interaction with the income tax assessing officer. The Commissioner Appeals appellate system was also made faceless. Now the department, encouraged by the response there, of course it's a debatable issue, has gone in for even the second level of appeal, which is the Income Tax Appellate Tribunal. They would also be faceless. There would be one central system on which you would have those second appeals being decided. Now, to summarize, what would one say? That a government has very aggressively and boldly gone for its borrowing program. It has said that we borrowed heavily because we needed to spend in the pandemic. Now the worst is over. The GST figures of the month of January, they are 1.25 lakh crores, the highest ever, 8% increase on January pre-COVID era. So therefore the economy is picking up and the GDP would grow and the debt to GDP ratio would automatically come down, and as government revenues increase, so does its capacity to service that debt increase. Great emphasis on creation of agriculture, infrastructure, dedicated fund being created. Then of course you have a very core focus on the health sector. We've realized that ultimately it is the health of the citizen and the population at a demographic scale which is going to be the asset, especially where we have got a young population. And of course the super senior citizen and the NRIs. The normal salaried person may have been a little disappointed. There are no tweaks and no sweeteners from the income tax. I don't think this was a year where people expected that. And now it remains to be seen that on the implementation side, all the schemes of Government of India, whether in terms of the health or agriculture, cess, etc., whether they are going to be implemented quickly, with a quality, within the time frame, those need to be seen and watched very closely. Overall, a very interesting budget. The stock market has categorically applauded it, and overall there are no nasty surprises. No person has been found sulking as to why this has happened. Of course, budget documents are huge. The finance bill and statutory documents and notifications, it takes the market and the country to digest and ingest the budget over at least next 3-4 days. But I personally would put the budget, if I were to give a rating of 4 out of 5, given the very difficult circumstances and the legacy of COVID era, I think it could not have been better. Of course, there are scope for improvements and people can make micro suggestions, but I think overall it's really a very good budget, and we as citizens now need to work together to take the country's economy to the next level. Yes, Colonel Chima is saying that, but even the finance minister in her press conference said that, well, Provident Fund being tax free, there has to be a limit to it. You cannot keep on saving. I mean, a person who's earning and actually investing 1 crore of rupees per annum into the employee provident fund is not the one who would deserve this. This is again a debatable issue, but right now they have said it would be limited to 2.5 lakh per year. So you can invest elsewhere. You can invest in equities, and long-term capital gains is virtually non-existent apart from a small security transaction tax that you pay. So friends, good to have joined, and if there are any further questions, please do leave in the comment section and I would try to revert back. And I would say that these are personal views and of course in my personal capacity and subject to my own limited understanding of the budget as I have seen from the media and downloaded from the official documents. Have a great evening ahead.